Oops. Let's go gallery view. Sorry, just give me 1 second here. I just want to get, there we go. Okay, so hey guys, welcome back to the Investing Advantage podcast. Today, I'm joined by a very special guest, Richard C. Wilson. Richard is the #1 best-selling author with his book, The Single Family Office. He's also written How to Start a Family Office, and the book I liked best, which was Capital Raising. It's a book that I've used kind of as a playbook, if you will, for raising capital for my own deals. Richard works with families worth 100 million plus in net worth, managing their family offices. And I think the insights and principles that he's gained working with those wealthy families is going to be kind of an insight into the world of really wealthy people that most people don't have access to. So very excited to have you, Richard. And maybe you can kind of even just start off by, a little bit of a backstory and what family offices are for maybe people that aren't familiar with it.
Yeah, sure. And so I started the Family Office Club 12 years ago and really grew it to help myself understand and navigate the space better. But very quickly, I found that even family offices themselves, who are ultra wealthy, only talk to 10 or 20 of each other, their peers per year. So after speaking at a couple hundred events in a dozen countries, I realized that I had spoken to more family offices than even family offices have, which was kind of backwards for me to realize that. But then we started hosting our own events, and after 12 years now, I've hosted 130 events. I've helped over 100 ultra wealthy families start their family offices. So a family office is really just a ultra wealthy solution for how do you manage wealth, protect yourself from overpaying on taxes, and manage your personal financial affairs more effectively. There's really two types: a single family office for yourself and one family, or a multi-family office that serves multiple families. And in our business, we have our media platform and all of our events. We help people raising capital through capitalraising.com and the free book, familyofficedatabases.com and pitchdecks.com. And then on the investor side, we have a performance-only division that works with investors. And we work with ultra wealthy investors who want to set up a family office or get more deal flow and improve their direct investments, and just charge them a 5 to 10% performance fee on investments they make through us, and no other fees included. And important to say that because we might talk about deal flow. And what I found, interestingly enough, is that when I have been working on both sides for a long time, I'm more effective for someone raising capital on my advice, because I'm texting, calling, emailing with the family offices every day. And then the family offices find me more helpful because we have $4 million a year in overhead hosting these 30 live events per year. Yeah. So those 6,500 people coming to the events means we have a lot of deal flow for the families. So some people get thrown by it. They're like, wait, are you a broker? Are you a consultant? Are you a conference guy? And so we're both on purpose because it makes us stronger for both.
Right. So you're almost like a market maker where you know what the money wants. And am I getting it right?
Right.
And then you also understand, or you have a pipeline of deals, and you're able to then see the best of the best because deals want money. Is that fair to say?
Yeah, it's exactly right. No one's ever said it that way before, but it's basically, if you only see 100 deals a year, what's your top 1%? One deal.
Right.
By really family offices, smart investors, they want to see anomalies only. Like what's not usual, what is like exceptionally great and high conviction. Okay. And I think that is what they want to spend 100% of their time on. And it's hard to do that. You have to kiss a lot of frogs and see a lot of volume of things. Just like in commercial real estate, especially where we are in the market now, you have to have a unique strategy, a great team, good negotiating, et cetera, good execution, but also define a deal that meets the criteria, is harder now than at some times in the cycle, is what most people are saying, at least.
So are there trends that you're seeing right now where family offices they like certain asset classes or certain locations? What is it that you think is kind of the sweet spot or the things most attractive to your clients on the family office side?
Sure. I think, lending is of a little bit more interest now, just because of how late we are in the cycle. If there's something with collateral, with a lending opportunity, if somebody can invest in a debt opportunity instead of equity, getting a little bit more debt investments going is something of interest to clients that I work with. Also, I think that one mistake people make in assuming what families want is they think they want an astronomical return. So they go around promising a really big IRR, and we're going to, triple your money, et cetera. And it turns off families because then they think you're going to promise the world. So if you don't deliver the world, you're now risking under delivering, and they want to work with people who under promise, over deliver. So you get labeled as kind of like amateur, not for us from the very beginning when you say, it's amazing, it's out of this world. And then some people say, oh, it's very low risk, it has no risk. And they, like almost everything has some risk.
Yes.
And so when you say there's no risk, then that means that you really are pretty new to the industry as well. There's usually some risk in there, even if it's illiquidity risk or some sort of, some sort of risk. And then the most important thing about the mistake of saying either of those things is that really families want the team and the strategy to be high conviction, long-term commitment, consistent execution, and they can really trust the manager. They would rather invest in something with 12% returns where they just trust the strategy and the team all the way through, rather than invest in something that's promising a 20% or 30% return that has supposedly better collateral. If they don't trust that that collateral actually exists, or that you're not going to flee the country, or like the firm's not going to crumble, then they're just scared of that. And they might not say that out loud.
How do these family offices, how do they vet the teams, if you will? Like, do they have a process? Is there kind of red flags that they look for?
Yeah, there are different ways. I mean, some families will vet teams much differently than others. The larger they get, the harder the vetting process gets for those raising capital, of course. And the large multifamily offices, they operate really almost like institutions, because their list is so long of how they vet families or vet investments. But many times it starts out by showing teasers to families, and then they look at a teaser, they shake someone's hand in an event, they say, oh, that's interesting, I would like to learn more. They then hopefully get sent a one-pager and or a pitch deck. And as they look through that, they're often digging into, does the strategy make sense? What about the structure? Can we understand it? If the structure is too complex and convoluted, or the fees really high, then it's that much more of a hurdle. They must really trust the team, or the strategy is just amazing.
Right.
Otherwise, they just kind of move on. It gets lost in the shuffle of everything, and they move past those groups. But what happens then is that it needs to be an in-person meeting, unless you're raising just $25,000 or $50,000. Everyone's made those investments maybe with someone that's at a distance they just do a Zoom call with. But for almost all investments, you have to then meet in person.
Yes.
And not being able to meet in person can delay a deal by weeks or months. And that's why a lot of family offices buy private jets, because they can get co-investors faster, and they can get to places like Nashville without a connection that's, might be hard to fly to from some cities. And so the meeting in person is connected to the idea that trust and high conviction is more important than anything else. And if you can bring a family and show them the assets in the portfolio, and you can show them exactly what the money's going into and how the team operates, then it changes everything. So, it doesn't matter how good you are at selling, it doesn't replace meeting in person and showing them the real life asset.
Yeah. I've found the same thing. I mean, once you have that relationship established, it's much easier. I can send out a text now, and people will, but that relationship has been cultivated for 10 years, and there's a track record.
Right. And you just brought up something I don't want to gloss over. I think most people listening might not have caught what you just said, because we've had people raise hands at our events about this, and nobody uses text messages when raising capital, and no one uses direct mail. And Dan Kennedy says, if you're not sure what to do, just do the opposite of everybody else. People will raise their hand at our events of who gets 100 emails or more a day. Everyone's hand went up. I said, who gets 1 or 2 pieces of thought leadership per month that's just pure value? And only 1 or 2 hands go up. That's 1 a month versus 100 a day. So just for people listening who are on that side where they're raising capital, you just naturally kind of said, oh, a text. But like, I found almost no one actually uses that strategy.
That's interesting. It's funny because I don't have conversations with other people that are raising capital. Usually people come and say, Shane, how do you do it? Or what do you do? I do it at a very small level compared to what you're used to. Actually, I'm curious, what's the deal size that your family offices like to invest in? Because I don't have a context for that. I mean, is it 5 million, 10 million? Is it $1 million? What?
Yeah, we have like two kind of types of families. We have the larger families that, like today we had a call with a $10 billion family, but we also had we had a meeting recently with a $130 million net worth family. Those types of families are looking to put a lot of capital to work at a time, 5 million, 10 million per investment, sometimes more, but they'll sometimes test somebody out at $1 million or
Okay.
$500,000, and hopefully they can grow it systematically.
Yeah.
But then, like we were talking about before the call started here, we have a surgeon group of investors called the Registered Surgeon Association. And I just hung up the phone with one of them, and they're many times in a different spot. They're the 10 million to 40 million range, most likely. And many of them, like we have 8 different deals under due diligence now with some of our clients, and those deals are ranging from 250,000. Actually, we have one at 150,000, but they're ranging from 250,000 to 1 million per investment.
Okay.
So a good rule of thumb is, if the family's under 50 million, they might top out at $1 or $2 million investment, unless it's a big platform investment in a space they know really well for a check size. But with debt, they could buy larger assets, obviously. And then for larger families, you can have to scale the numbers up from there. But for anyone raising capital, they should know that lots of times people want to test out an investment on someone, and they might really want to allocate $1 million, but let's do 250,000 for this one. We'll do $1 million next time if it goes well or something.
Yeah. And frankly, I kind of prefer that too, as a person that raises capital, because I want to test out who the investor is, right? Because the relationship is two-way. I think sometimes what happens is investors are so eager to raise money that they accept someone into their deal, and they may not realize that that person is now pulling the strings and can. It's a two-way street, I guess. That's what I'm getting at. So.
Yeah, for sure. I think it's important. And they've shown that once somebody has made a single investment of any size, they're now more confident and more excited about that investment in that area. So, it helps in terms of learning for the investor to make a small investment. They can learn a ton and go up a learning curve by seeing what is going on if the manager is transparent. But also for the person raising capital, they might make a referral to 3 other investors who would also do test investments. Absolutely. Or they might also refer you to one investor who makes $1 million investment or more. And I think that sometimes that gets overlooked when people say, oh, we have a $1 million minimum. But it's like, well, for a first-time investment, you might want to lower it. You could have your second-time investment be a minimum of 500 or $1 million. But, I would lower down the first one to make it practical.
Yeah. I like that. I'm curious because I received an email not long ago from someone saying, hey, Shane, I'm looking at buying. Actually, I think they wanted to get a list of doctors and kind of high net worth individuals, and they were going to kind of send out direct mail. I don't have any experience with that. So my thought was, why don't you start close to you in terms of people that you know and have some sort of context for you before kind of expanding out? But I don't know if that's the right advice. So I'm curious, how would you suggest to someone that's new to raising capital or kind of investing, what advice would you give them on what to do?
Yeah. And I think this will hopefully come off as genuine because we're doing it in real time right now with that Registered Surgeon Association idea. But I don't want people to get distracted by that example. So this could be manufacturing, high net worth individuals who've had exits in manufacturing. It could be consumer product companies. It could be fintech. And I've helped clients, and we've done this internally with all those different niches. So the trick, I think, is to focus on people who already know your industry, because people invest when they're confident, really confident in the team or the CEO. They're confident in the industry or they understand the industry, and then they can go see the deal or conduct very good due diligence on the deal. And if those 3 things line up, they easily invest. If they're at ground zero on all 3, you might as well not even be having a meeting with each other because nobody's going to get anything done. So I think that starting locally is super important. Direct mail is important, but nothing replaces that face-to-face meeting. So I've written several books. You were nice enough to mention some of them earlier, and we have websites. We mentioned a couple earlier. But those are just digital ways to create a face-to-face relationship and meet in person. So I would add on top of the newsletter direct mail strategy, systematically reaching out to the ones who are most local to ask them to have a cup of coffee, stop by their office, invite them to an educational lunch, invite them to an event that you have access to, like an art event or a nonprofit event or some fun, event that's passion related. And thank God the sun went down there, so I don't look like I'm in a cave over here. Usually my lighting is better, so I apologize for that. But like figuring out different ways to make the engagement go up. Without engagement, it doesn't matter how big your list is. Otherwise, everybody who sold a database of investors would be a billionaire because they've raised all this money. But you need to have 30 different things in a row to have it go well. And one of the really important ones is engagement. And the way you get engagement, I find, is to know your target investors so well that you know the words they're searching in the keyboard on Amazon, you know what they're searching in YouTube, you know what they're searching on Google, and you're capturing them through Google AdWords, through websites, through a logo that just by the brand name that you've chosen, you kind of hit them between the eyes because they know that you're catering to people just like them. And the more you can do that, the more engagement you'll get. And the more that you can focus on things where there's not a lot of competition saying the exact same thing,
Yes,
the more you'll get a positive response. And like we do that by saying we do performance fee only family office solutions. So we're just charging typically a 10% lower for larger families, but a 10% performance fee on deals that they invest through us. And we don't have any management fee, consulting fees, et cetera. And that's an example of saying something unique. And I think everyone needs to come up with that. So I know who they're targeting and just have a really unique offering and just add value first in every way possible.
Huh. Well, that I can see how that would really align with a family office. I mean, on performance only. I mean, when I used to sell commercial real estate, that's how we made money. And
Right.
so on the understanding your audience, and I listened to a podcast or an interview that you did with Dan Sullivan, and I think you talked about kind of really understanding the sandbox that you're playing in, if you will. Could you maybe just kind of like you touched on it, but I think that is so key, and it's an area that I need to improve. So it's going to help me and the audience, I think. So.
Yeah, for sure. And I think Vern Harnish talks about this in Mastering the Rockefeller Habits if someone wants to go real deep on it. But essentially a sandbox is an area you want to occupy and do really well in. And it's connected to the fact that, I think integrity is the most important thing for an investor and for someone raising capital. Because if you have everything integrated from where you work to, the clothes you wear, the friends you have, to where you live, to what goes into your investment portfolio, to what your skills and DNA is, to who is on your team and your core values in your company, if all that's aligned, then the world makes way for you and things go smoothly. Otherwise, you have constant friction, and no support, et cetera. So having the right sandbox means that you have kind of a true north that you're pointing everything towards.
Yes.
And the way to look at it from an investor is, where's my expertise as an investor, as a private investor, and how can we be more effective? And that usually means identifying one or two areas of cash flowing real estate if you're just getting started, maybe a third if you have experience, and moving up those learning curves and starting to allocate and learn. And then on the operating business side, it might be, okay, well, I was an oncologist, or I made my money in stem cells or manufacturing. Where do we see a growing, rising tide in manufacturing where we can really make a mark? And maybe it's in distribution of manufacturing parts. Yes. Maybe it's in manufacturing tech. There's a lot of new technology that makes manufacturing more efficient, and investing there, because I think that's the future. Mm-hmm. People don't talk about that. Or like a $200 million family flew down here and stayed at the Ritz-Carlton for a day to meet about setting up their family office, and they made money in consumer products. So I told them, instead of just buying companies and building up a platform of companies linearly, you could be getting companies that maybe a top 5 Amazon seller account in consumer products, or a direct-to-consumer website. Buy one of those. Now you'll get more deal flow from your customers on those websites. Yes. Every company you buy, you can now push the products through that distribution source. And when you negotiate deals, you can negotiate, hey, we want a 5 or 10% better valuation because we're going to jack up your sales by putting it through our distribution channels. And it just makes your returns better, your negotiations better, your cost basis lower.
Yes.
And for an investor, that would be the sandbox. For someone raising capital, it's saying, okay, we want to be dominating the niche of how to start a family office. We're going to write a book, we're going to create videos, we're going to add content like white papers and webinars and give speeches publicly, and build up the walls around that sandbox so that when someone else says, hey, I want to compete in the centimillionaire niche that they see, oh, okay, well, they already have 18 different assets and pieces of thought leadership there. Maybe we'll define our business a little bit differently than Shane does, because we don't want to go head to head against Shane. He's like 8 years and 10,000 hours ahead of us.
Right.
And that people don't enter your sandbox as easily. Because you can have a really exciting sandbox, but then nobody wants to do the homework of building the walls around it, like doing this podcast that you're doing right now, or writing materials or giving speeches, because it's hard and nobody's born good at writing and speaking typically. So I think that the homework, it's valuable. Those walls are so valuable because no one wants to do it. So finding a good niche is important, but then defending it and making it like a big moat is the only sustainable way to do it.
Yeah, I'm so happy you touched on that. It's actually kind of like a core belief that I have, which is the harder it is, even though it may kind of suck in the beginning, just understand that that's going to deter 99% of people from entering into the space that you're in. And so, I mean, I haven't seen anybody in the family office space, so I can just imagine how, you know, your fortress is so well protected.
I think that's so important what you just said. I think people underestimate how important that is. Like Gary Vaynerchuk said in one of his videos that he loves tedious things because nobody else is going to do it. Mm-hmm. And if you think about your niche and you think about how many people are willing to do a podcast, how many people are willing to speak publicly or write anything, how many people have your focus, and how many people are going to stick it out long term, it gets down to like you maybe have 3 competitors globally, or maybe 15 if you're in a certain area of real estate. And then it's just about longevity and finding your unique angle. And if you survey the land beforehand, you can choose that niche that is not occupied yet. And importantly, to note, the big gorillas in your space, they can't now change all their branding to only cater to that hot niche that you've now attached yourself to, like manufacturing tech. You know, they do 50 things in manufacturing, so they'll never be known as the firm that is ultra specialized in that one thing.
Wow, that's really, it's just number one, reassuring to kind of hear that, and then and sometimes just bouncing ideas back and forth, it just solidifies when you're maybe onto something.
Sure. Yeah, I talk about that stuff just for fun with my friends, and we talk about it at our workshops, etc. So happy to help on anything related to that you'd ever be wondering, or have you as a guest at one of our events for free, since you're nice enough to have me on the podcast here today, just to get to know each other better.
Yeah, no, that'd be fabulous. We talked about this just before we started recording, and it was on the concept of deal flow. Can you maybe just talk a little bit about like how do you get such kind of good deal flow?
Yeah, I mean, I think some people who are sophisticated hear double your deal flow and they're like, oh, give me a break, I already have too much deal flow. Most people don't have that problem, but the most sophisticated listening might be thinking that right now when you say double your deal flow. So most importantly, I think we need to start with investors are most effective when they focus, like we talked about earlier. So coming up with your 10, 20 criteria of what you want to invest in and why and where. Do you need control? Are you okay with non-control? What's the LTV? You know, what's the alpha you'd expect in the hedge fund manager? What's the return expectations, the risk parameters, et cetera? The more you can be detailed in all of that, the more you can focus on doubling your really good deal flow, the really well qualified deal flow. I just want to like add that caveat. But the ways we help clients double their deal flow, one is we help position them. So where are there lots of people that are looking for strategic investors that would be related to your area of expertise? You know, are people literally searching online for manufacturing strategic investors every day? Are there conferences you can speak at as an investor or an investment firm to get in front of CRE brokers or get in front of people that own the assets? Can you look within local county records and look up who owns the real estate assets and create a database of them? And if they're all being protected by one lawyer who formed their LLCs, then you should go meet with that lawyer and take them out to lunch or refer a client to them and try to, you know, see how to work with them. You also can find where there's big events where the event is really industry individuals and you're going to speak in front of it. Maybe it's law firm partners and you have a litigation funding offering, or maybe it's medical professionals and you're raising capital for a medical plaza, but it's like a Dental Association of California event and everyone's there pushing their devices and you're the investment person there. So that's a couple ways you can do it. And then one really good effective way I found is, we've done this for a few clients now, is you find the definition of what you really want, then you go out and create a database of all those assets that exist out there in the world. Like we did it for one type of company. We identified 375 companies that fit that criteria. So I made a database of those.
Yes.
And my team made that for me after I told them the characteristics we want. Then I wrote an email one time. My team customized it. And it was a single sentence that hit them between the eyes with, we are a family office that made our money in X, and we're looking to invest in companies just like yours in the Y space.
Yes.
It was just a sentence long. Would you like to have a short call? And then I would attach a PDF of our investment strike zone for that family office.
Yeah.
And a link to their website. And if they go to the website or open the PDF, they'll see, oh, yes, they do only invest in Y. And here is the background. And here is a little bit about their portfolio. You don't even have to say the family's name.
Yes.
But it's so much more effective than sending them an email from a Gmail address or a website that doesn't say anything. And in that one sentence, will usually 1 out of 3, 1 out of 4 will reply typically. And I got on the phone with 70 out of 375 emails sent.
Yeah.
And then out of the 70, we identified 8 that were investable, and we got 2 deals closed from that process. And that negotiation process is, to this day, has helped us in that industry because we know how to value companies, because we have 70 phone calls with CEOs and said, what's your company worth?
Yes.
The magical thing about it is a lot of them said, I don't know, no one's ever, offered to invest in my company. What do you think it's worth? And, that's the best thing you ever hear as an investor.
Yeah.
Because, oftentimes we're doing minority investments in that case. So you don't want to steal the business from them. They won't have enough to stay motivated, but you get a better valuation that way, right?
Yeah.
So that's a long-winded answer, but those are some quick ways on how we help double deal flow.
How long does that process take? Because as you're describing it, I'm thinking to myself, like I got excited and then I quickly thought, that's a lot of work. And you have a team that's doing that, which is...
That's one of those tedious examples.
Yeah, I know.
Do it, right? So I'm acting on what I was saying. Yeah, so that can take 2 to 4 months. In that case, we took 7 months to do it because there's a lot of follow-on conversations until we got to an investment.
Yeah.
But if you're going to be in a space for the long term, then that's going to pay off for the long term.
Sure.
And we've had some deals come back to us. One of those individuals, 2 of them now actually, 2 have had exits. They sold their company for 10 million. The other sold it for 30 million.
Yeah.
And now another company in that niche that I'm placing capital into in the next month, we're bringing them on as potential board members and seeing if they want to invest too, because they've had an exit in the space now. And so it's come full circle, even though it's only been 2.5, 3 years since I ran that process for that industry. And so if you're trying to do this in an area that you're not long-term focused on, then I would just find another niche where that you're going to be in it for the next 10, 20 years. Yeah. So it's time to roll up your sleeves. And if you want to dominate the sandbox, if you don't feel like it's worth writing a book, giving speeches, or doing that type of stuff, then you're not on the right sandbox. You're not high conviction enough.
Yeah. Yeah. There was just so many things that you said there. So I know I've worked on deals as long ago as like 7 or 8 years ago. And I created a relationship with someone and it didn't come together then, but then 3 years later, they sent me another deal and they introduced me. And so you're right. If you're focused on kind of immediate gratification, if you will, then these larger transactions and relationships, they just take time. And and so
I couldn't agree more. 4 to 9 months is kind of the average for a family office deal to get closed. And many family offices will say we never close deals with people we haven't known for a while first. So you gotta plant seeds with the larger investors and kind of nurture those over time.
Yeah, absolutely. Hey, I'm curious, like, how did you, I don't think that I really understood this when we first started chatting, but how did you get into family offices? Because it seems like quite a, like it's so niche, and I've been an investor for a long time. And until I came across your book and then I went down the rabbit hole, I never would have even thought of this. So what? Yeah.
Well, the question, it's kind of similar to the question, why'd you rob the bank? Because that's where the money is, right? So, so when I was getting started raising capital, I'd done risk consulting, bored out of my mind, but paid for my MBA. And I said at age 22, who's going to, pay me that well for this job I kind of got lucky getting and I'm grateful for out of college. But paid me more than I should have probably. But then I said, okay, commercial real estate sales and brokerage, doesn't matter how old you are, it's what you get done, or raising capital for hedge funds and such. So I went the capital raising route. And while doing so, I tried to go to wealth management firms that didn't have enough accredited investors. I tried going to institutions. They wanted us to have 500 million in our fund manager before we could pitch them.
Okay.
So I said, what do I do? So I found these high-end wealth management firms. I was like, okay, this works, but what do you call a high-end wealth management firm? And then one of them on the phone said, oh yeah, well, we're kind of a family office. I don't know if you've heard of that. It's a new thing. And that was in 2006, 2007. And I said, no, I've never heard of that. So I took that down as a note. And I said, oh, well, I'm only going to call on family offices. Then I found that was almost impossible to do. It was hard to find them. Not many people called themselves that back then. Yes. But I started talking to them more and focusing only on them. And then I started posting when I would learn something by meeting with them face to face. I would share it online. Right. And it started getting 100 hits a day on the website, and then 500 hits a day, and then 1,000 hits a day. And I got on the front page of the Boston Globe, and then in other media, publications, and then got invited to speak, over 100 times in 14 countries with my now wife. I got to go to fun places, and it really took off from there. And then it was just listening to what the family offices were asking me for and making sure I was always serving them. And then I knew the capital would always chase me if I was serving the investors well. So, the name of one of our 5 training workshops out of our 30 events, one of them is called Private Investor Advantage. And so it's about giving them that advantage. And I think that when you can genuinely help somebody first, you earn the right to have a meeting in person or, get to know them. So that's kind of the short story of how I got started.
Did you ever, because when I first started sharing some of this information and my, I don't talk about it too much, but my wife's family, they're quite, they've got kind of a publicly traded development company. And so they're well known. And I wanted to be very respectful and make sure that I kind of focused on kind of talking about my own experiences. But then some of my investors would ask questions like, Shane, you're sharing like trade secrets and why are you doing that? Like, why do you start a podcast or write a book? And do people kind of, do they have the same concerns about, because I know you put a lot of content out. I know you're very respectful about confidentiality, but I'm just curious, do people say like,
I'm sure some have those concerns. I just don't talk to those people, but I think that, if you keep everything secret, no one knows you're an expert. And there's a way to share insights and lessons without violating the privacy of someone. So I can say that earlier today, I met with a fintech company, that I invested in. And by the time they sent the wire transfer, the valuation has gone up 10 times, and it blew my mind. And, who knows, maybe the whole thing won't, make it to an exit, but it's like totally different than investments I'm used to doing. And then today we had a call with a $10 billion family office, and they're desperate to put their capital work. We also had a call with the Sovereign Wealth Fund, who I introduced one of my family offices, who's buying a chain of 50 franchise locations of a restaurant. And their concern was the deal was too small, the Sovereign Wealth Fund. They were complaining like, I don't know if it's worth getting out of bed for. And so like, I can share those things, and I didn't say the name of any of those clients. That's right. I'm not selling a security. I'm not pitching anything. I don't broker or pitch deals. I only work for my investors, helping them find deals. So I think that those are examples of how you can do it.
Yes.
And there are people, the philosophy, you shouldn't talk about anything, but then you're not being helpful to anyone. And I think the person who's most helpful wins. And in my goal over the next 10 years is to be the most helpful resource in family offices and investor relations and the connection between those areas. And if I can continue to do that, then we'll continue to have a growing business. And that's how we attract all of our clients, is they cold call us and cold email us. And then we get the conversation going.
Well, I was going to kind of transition into that in terms of like, where do you see yourself in the next 10 or 15 or 20 years? Like, what's the envision? Because you're in strategic coach, are you not, with Dan Sullivan?
Yeah.
So I imagine you're very intentional on the direction.
Are you in strategic coach as well?
No, I've had conversations. I have a different coach, but
Oh, okay, sure, yeah, no, I love it. I'm in the Frontier Zone program, their top level program. The people in there are excellent. The ideas are great, and I've got to do. You saw the podcast. I got to do it with Dan recently here, and great ideas come from there. But yeah, my long-term vision is just to create and maintain like the Nike brand of the family office industry.
Yes.
And be the most helpful over the long term. Personally, I'm working with $100 million families often enough that I stay interested because I can bring their strategies into what the family office club is doing.
Yes.
And help our new clients with doing the things the ultra wealthy did to become ultra wealthy and stay that way. So that's what constantly excites me. And my big goal is to get our company's size up to $100 million a year in revenue. And we're really just trying to screen opportunities. We'll work with investors starting at 15 million net worth, but trying to screen opportunities by, is this person playing a $100 million game?
Gotcha.
So there's, is this meat company, is this fintech company really going to make it to 100 million in revenue or valuation? And if not, then we try to just pass on that and look for the next thing, because when there's lots and lots of opportunities, you can afford to be picky, and we really just want to try to work on high conviction things we're excited about, so it's worth putting energy into.
I want to be very respectful of your time. I don't know if I'm sure you're
Sure, we can do another question or two, no problem.
Okay, perfect. I guess, like, based on your experience and what you're seeing in the market, if you were to deploy $5 million or $10 million today, knowing what you know, and it doesn't have to be geared to just real estate or commercial real estate. I'm curious, are there places, it could either be asset classes or cities or locations or trends that you like? Like, where would you put your money if you were an investor?
Sure. I would hold on to $1 million of it in cash for a downturn. It's one thing, maybe close to $1 million. I would put some to work in lending deals with hard collateral behind it. So the worst case is that you own an asset and you don't lose all of your money, or you're illiquid for a bit while you let them work it out and don't go through the messy process of getting the actual collateral in your possession. I would also look at structuring. I like to do operating business investments with gross revenue royalties attached. Okay. Meaning I've done 2 of these. I'm about to do the 3rd one now in the next 6 weeks or so. And it's where we invest and we get an equity warrant that gets activated at the exit down the road. But right now we get a 1 to 2 or 3% gross revenue royalty until we get 1.5 or 1.2 times our money back. Once our money is off the table of what we invested 100,000 and we get 120,000 off the table, then maybe our 5% equity warrant might go down to 4% or 3%.
Huh.
And that way we get our money off the table in a fast growing company that might otherwise not show a lot of profit dividends.
Yes.
And then the person raising capital likes it because then you can have it so that the equity amount goes down once they've gotten all their money back, because now they're riding risk free. They're already gotten their cash out of the deal, and you can go and recycle that cash in the next deal. And it has a really big benefit of helping both parties, because you have to deal with the amount of money you're going to invest, the valuation, which usually holds up a lot of deals, and the what return do you want, 1.2, 1.5x return until the equity warrant goes down. And you can change the amount the equity warrant drops. So someone who's raising capital wants to preserve their equity could say, okay, we'll do this X valuation, but I'm going to give you 2.5 times your money back. Once you get 2.5, your equity goes from 5% to 1, because you already made 2.5 times your money. So you get a 1% sweetener, but you know 2.5 times your money off the gross revenue royalty is a pretty good deal in itself. So if you're concerned about preserving equity, that's a strategy. I would also invest in areas that I think inevitably will be a hot area over the 10, 20 year kind of macro timeline. So in each city, sometimes there's areas of real estate that's near a new transportation hub, or it's an area that hasn't turned over yet, but it's real close to downtown that you think in 15, 20 years inevitably is going to go up in value. And I think that those types of ideas can be good, or an area like stem cells, or an area that like manufacturing tech or energy efficiency solutions for a CRE that would inevitably go up. And then the last thing I'd say would be, I would also just look within all the deals that I am showing to clients right now and just think, what's the most high conviction strategy where the person just seems like they're just a killer at what they do. They're just, an absolute expert. And so during a downturn, they might be less liquid and the returns might go down, but the worst case scenario is not that bad. Yeah. And, that sounds like very soft and like subjective, but some things just look night and day better than others when you compare them side by side on the amount of experience and commitment and the excellence of the team. So I would diversify some of the other investments that way. And then the last thing I say is that I would look at things where I can make an impact and a difference. And so what we try to do is find those $100 million stories and then structure a deal, whether it's gross revenue royalty or not. It doesn't have to be, but where we can inflict change and help it go well.
So when you invest, because it sounds like, so will you be investing in some of these deals with your own money passively?
Yes, I do. I do right now, not in a lot of deals per year, but a handful of deals per year. I'll put my own money in, and then if my clients don't do well, I get zero fees. So I give them only conservative deals, that I think are genuine.
This might sound like a bit of an odd question, but it's something that I've started to do where if I'm looking at someone that I don't really know, I have a tendency to be give them the benefit of the doubt and almost be more trusting. And so what I'll do is I'll bring my wife along to some of those kind of meetings because I think that she's a better judge of character in some capacities.
Right.
How do you, like when you're meeting with some of these principals in the deal, because I think that you said like, if the deal, if you go into a soft market and you see stress, it's really the person that's in the deal, that is either going to fight and keep it going or, fold up their tent and go home. Is there any strategies that you use that would be kind of unique to betting deals or people?
I think taking somebody out for a drink and seeing what happens, are they starting to treat everyone rude around them? Do they have 5 drinks? Do they start saying, oh, well, what I really want to do is blockchain stuff, even though I'm doing commercial real estate today? Are they totally unkept and unprofessional and sloppy? Do they cuss a lot? I'm not against anyone having a drink, but I haven't drank in 7 years and I'm health minded. So for me, it helps if somebody is health minded and I'll recognize their Garmin watch, or we'll talk about something we have in common there. I think also your subconscious, in 0.2 seconds from 50 feet, you instantly judge whether somebody is attractive or not. Psychologically, they've proven that subconsciously. So when you're face-to-face meeting with a business person, oftentimes in the first 30 seconds, I know I will never do business with somebody because their demeanor, the way they talk, maybe they're all stressed out and being kind of pushy or rude or desperate to get their deal done or sloppy, or if anything makes you uncomfortable about them, even if you don't know why, then it's done, because it's just not worth it. And there's many other people you could be placing capital with. So you have to really think, is this someone that I really do trust when I'm not looking that they're going to do the right thing and they're really committed to the long term. And I think that's what I try to rely upon most.
Yeah, I think that is I've learned so much. I mean, you can see the notes I'm taking as we're having this conversation.
Sure.
But I think that is so key. Just having trusting your gut, because it's very easy to financially engineer a spreadsheet or a pitch deck. I mean, of course, you're always going to show the most, all the wonderful things that can happen in a deal, but it's really that individual and their character. And I think you said the word integrity. That's really going to determine whether or not, it's successful, right? Because you can have a wonderful deal and maybe not such a great principle. And
I hate it when people overpromise. It just blows their integrity. And the whole point is you should be over delivering, not over promising. And one individual who ashamedly was at one of my own events. We don't have a lot of these types of people at my events, I swear. But one person at my event in London last year said, oh yeah, look at this. We're going to build this resort on the water. And it was obviously a 3D rendering. I was like, wow, it looks like a big project. Have you, and she was saying there's no risk. There's no risk at all. And I was saying well, have you done a pilot study yet? Because you said there's no risk, but in development, financing can get pulled or a permit not offered or delays can happen. All sorts of risks go into this. And she's like, oh, well, we haven't done we've done a pilot study on the computer, and that was her response. And I was like, just leave and never come back to any of our events. But our whole role is to try to teach and help people move up that learning curve. some people just don't know, but she was extra pushy and extra uninformed. And that's the worst combination.
Yeah.
It's like, I don't want to say the word ignorant, but you're new to the space,
Yes.
but you're also stressed out and hyper pushy. It's like, I'm not like a hyper pushy guy. And so it just really puts me off. And I think it puts a lot of investors off.
Yeah, absolutely.
They can have patience for not knowing everything and not being an expert. If you have some real value to add or a valuable deal and you packaged it wrong, they might forgive you for that. But if you're also kind of a jerk, then it's like instantly gone,
Yeah. The red flags for me are guarantee. When
Right.
people say that word, I'm just immediately I shut down.
Right.
And no risk. I mean, those two to me are just, because there's always risk. And if you don't think there's risk, then you probably haven't done enough investments, unfortunately.
Yeah. As someone on stage at our investor event said, if somebody tells you there's no risk, they're not going to lose your money. They're going to steal it.
I like that.
Which, I don't know, maybe they're new to the industry and they just don't know better. But I think that's the importance of a podcast like yours, is like, you have to know this stuff, because some investors are not going to tell you how you messed up.
Yeah.
They just won't answer your emails or calls anymore. They're too busy to take time to give you detailed feedback on the 4 ways that you messed up, perhaps.
Yeah. So in terms of communicating with your investors, is there best practices? Is it quarterly, monthly, when there's significant events? How do you kind of coach, say, people that are raising money from investors?
Sure.
To communicate?
Well, if they're a current investor, then it's different, obviously, than a potential investor. And the whole job is to be kind of politely persistent over time. So if you are really high conviction that you should be working together and you had some sign that they are also interested before,
yes,
then I would follow up every 3 to 5 weeks, unless they're traveling like crazy or they have some big life event or they're out of town for the summer, etc.
Yes.
But I think you have to diversify that follow-up, direct mail, text message, if you know them well enough to do that and you have permission. I wouldn't text message a bunch of people, spamming them or something. Meeting in person is the best one, or inviting them to a fun local event that they would enjoy with the family or not, or with the spouse or not. I had a family office client who built a $1.5 billion business, and he bought a zip code in the middle of nowhere in a state. And he had a private jet, and people could drive there, or they could fly into a local airport, or he could fly them in. And then they had teepees and cabins and a horse ranch and a lake, and they had hunting grounds. And they would bring whole families there. People would say it's the most enjoyable weekend their family has had their entire life.
Wow.
And he would just build huge relationships around a campfire, having a beer or dinner, etc. And he said that was super helpful in building relationships. And it wasn't ridiculously expensive, because it was in the middle of nowhere, zip code of a bust mining town. So I think that's important to note, is just the experience and the value you add and the genuine insights you can provide a family is the most important thing. So if you don't have something to add value to them with, then I wouldn't really touch base as much.
Yeah. You're right. I mean, because this is a relationship-driven business, you just want to always be thinking, like, how would you want to be treated, and kind of making sure that you're doing things kind of in alignment with that.
Right. And trying to see, like, how's everyone else treating these investors, and how can you do much better? So some people do give away things to investors, like a booklet or a guide or a cheat sheet. So in our latest iteration for our investment advisory division, Centimillionaire Advisors, we put 10 different things in a Dropbox folder. And if you opt in on centimillionaires.com, you get 10 things for free, like an assessment tool, a guide, 50 questions you should ask yourself, 3 different books. And many people still aren't giving away something for free to potential investors or potential clients. So I think it moves the free line in the family office niche, that we put together this whole data room of free stuff for people. Yes. And I think that's something maybe some people raising capital could take away and use if they're feeling like there's a lot of multifamily groups competing against them or something like that.
That phrase, moving the free line, I don't know if that's Eben Pagan. I think you've...
Yeah, it's Eben Pagan. Yeah, he was one of my mentors early on, and he changed my life, with the advice he gave me.
Yeah, no, he's I just find it really interesting how you've taken a lot of the kind of sales and marketing from outside of the world of investing, because frankly, there's I've tried to find it. I haven't been able to see it, but just watching how you've built your business, I think it's a great illustration to others that are kind of looking to, build something, if you will, and not.
Sure, sure. Yeah. Thanks for saying that. Yeah, I mean, I think it's a business model where you're just being genuinely helpful more than anyone else. So you make a lot of business friends. Your competitors might see it as ultra competitive because you're always putting out stuff, but to everyone else, you're just being ultra helpful. So it's a nice business model.
Yeah. Is there anything that I should have asked that I didn't throughout this conversation? And I'll make sure that I hand off to where you would like people to maybe get more, if they want more information and whatnot. But I'm curious, is there anything that I missed in this?
I would just say for private investors, it's just so important to know what new reality you want to live in now that you are ultra wealthy, and how you got there, and what your values are, and what your mission is, and your objectives are. And then after you're very clear on that, and it's documented out for your team and your family, then you screen everything else based on that, rather than letting the world inform you on what you might want to invest in, or just kind of taking things without it being formalized. Because like in my experience, probably 95% of the $100 million plus, or even $15 million plus families, even more so, don't have any of that documented. It's kind of in their head, parts of it, but their team only knows part of that, and then their family only knows part of that. So it just helps so much. It doesn't cost anything. It's not like a $500,000 software solution that we offer. It's just being super intentional about, where you want to go, and then directing energy towards that.
Well, I remember reading your family office book and seeing, is that kind of where that was initially, that type of the questions to really get that clarity? Was that in that book, or was it in How to Start a Family?
I think How to Start a Family Office has that, but Single Family Office book talks about it as well. Yeah.
Okay. So if people wanted to get that type of information, would they go to familyoffices.com, or where would be a good, and we'll put this in the show notes too, but I just want to.
Yeah, sure. So familyoffices.com is where you can see our upcoming event schedule of the 30 upcoming events. You can see the membership options, a free book on family offices there. If you're an investor, though, the big collection of free resources is at cintamillionaires.com. And that's Cinta with an I in the middle, cintamillionaires.com. And then you get multiple books and stuff. Okay. If you are raising capital, like you mentioned, the capital raising book at capitalraising.com, or we've got, that's probably the best place to start for free information. For every one person that comes to one of our events, we've had 5,000 who download the book or that interact on social media. So I realize a lot of people listening might not work with us for a year or 2 or 5 years to come, or maybe never, but that's just our business model. So we're happy to be helpful to many out there and work with the few that want to.
Well, this has been just, it's been the most favorite interview I've had. And I really appreciate you taking the time, Richard. I think I've got 4 pages of notes that I've taken, and I'll make sure to have some links and a great summary of this. And we'll make sure that, for people that are investors, or maybe they have kind of a ultra high net worth, that they can get the resources they need to continue their journey. So.
Yeah, no, it sounds great. And I'd be happy to have you as a guest at one of our events. And then when this is done, I'm happy to share it on social media as well and spread it around.
Yeah, that'd be wonderful. I appreciate that, Richard.
Great. Yeah, thanks for your time, Shane.
Okay, thank you, Richard.